that. Just bring up the Nifty and the Sensex ones just to show what's happening per se. And it's a quiet day of trade yet again. We are now no longer holding 25,500, 25,416 and below. Sensex about 0.21% lower, and the broader markets too are very, very quiet. But individual pockets of strength and weakness. Tyre major MRF is in focus today, with several positive triggers bringing the stock back on the radar of analysts. My colleague Puneet is here to tell us more. Puneet, it's been a rank underperformer because it's underperformed the Nifty in the last 5 years. Why do you say it's coming back in focus?
Well, thank you for that. And you know, it's that before the earnings season starts for MRF, it seems to be that a lot of positives are already priced in, as you said, because the stock also hit a life high yesterday. It's been listed over the market over decades now, so it's almost hit roughly 1,51,000. We're seeing some pressure on the stock today, but it's been a very jolly ride over the last 3 months for the counter. Now, when you look at what's driving the momentum, we've just put across a few factors now, and there are 3 key things that you need to look out for. The one main thing is, of course, natural rubber prices. Now, it's a commodity business, so it is dependent on the volatility in prices that we see in natural rubber. That is starting to subside from the higher levels that we've seen over the last year in FY25, where it was just a flattish year. The second key trigger is expecting better export performance, and that will be led by growth in Europe. Now, that's a market which accounts for almost 1/4 of the revenue for all tire makers, including someone like an MRF, and that space has been not growing or absence of growth over the last 2 to 3 years. That is now looking at a time where we could see some revival there, and hence analysts are believing that at this particular point of time, that is currently at the bottom of the margin cycle, and hence apart from revenue growth, we could see strong margin uptake on this one as well going forward. Now, the key aspect which you mentioned of natural rubber prices, let's take a little bit a look at that. Currently hovering between 190 to 200 rupees per kg. It is going around 205 right now, but that's been one of the key ranges in terms of both essentially to put this as support at 190 levels for this price movement. Now, it is down from almost 240 to 250 rupees per kg that was last in June of 2024, and then has steadily moved downward, which is a key positive for MRF, which the company is also highlighted in their results as well. When you look at the other aspect of outperformance versus its peers, FY25 was a very tough year in terms of growth, but despite that, MRF continued to show outperformance with 11% growth, outperforming both CAT as well as Apollo Tyres. The reason you're seeing the profit fall by 9%, while it's a key negative, it's largely because of what's happened on the natural rubber prices. The EBITDA margins were down by almost 300 basis points, but look at the diversion it has versus someone like an Apollo Tyres and CAT. Apollo also has a lot of exports in Europe, similar to something like MRF, but you see the divergence of the market leader there, and hence we see the street putting in that positive momentum before the Q1 results happen in these 3 months. Now, how much more upside there could be from here? Brokerages are anticipating revenue to grow roughly about 9 to 10%, but this is before the earnings season starts, so we could see some upward revision there. Margins to reach 16% for the company. It's been hovering around 13% over the last 2 years. 16% in FY26 is what's anticipated, and that will be a big boost to profits going forward. Better outlook in terms of commentary as well as performance in Europe, as I mentioned, will be one of the other key triggers that we are watching out for. But what happened with the valuation? That's another aspect. Currently trading at 34 times price to earnings, and we've compared it with the average of the last 5 years. It's trading below that level. What's interesting is that for FY26, the multiple goes down to 26 for something like an MRF. And while it is expensive compared to its peers, it is showing higher growth, it is showing better margin performance, and hence the market also rewarding it with that kind of premium multiple. In terms of analyst target prices, we've just given that in terms of the top ranking analysts. CLSA has the highest target price, almost 1,68,000 with 11% upside from the current levels. And these are some of the other target prices from other brokerages. So in terms of FY26, it's going to be one of the year of revival for all the tire makers. And the market leader doesn't seem to be too far behind, at least in terms of what the price momentum is suggesting and what analysts estimate from starting from Q1 onwards itself.